Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, Chief Technical Analyst with StickyTrades, and this is a daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. As you can see from my chart, I had left my target lines there at 379.61. I've been pursuing that target for a couple of weeks now, and we came within pennies of that target. And you can see that today we did bounce. Now, if you go back and listen to the recording from the midweek report, you'll know that that's exactly what we got today. Now, moving forward, I'm going to project that we go a little bit higher up to 389.76. We might surpass that and maybe even go up to that 20-period moving average. Remember what I said 3 weeks ago, and please go back and listen to those recordings because they are so valuable. I had pointed out this bearish engulfing candle and comparing that to other bearish candles that we've had recently at that top. And I did say that we are in the process of duplicating this down leg. Well, guess what? That's exactly what we have, especially on the bounce. You can see that this is a bounce that has occurred after the gap here has filled. Remember, 80% of the time gaps fill, and then after gaps fill, 80% of the time, the prices reverse. And that's exactly what we have happening right here. Again, I have all of the links to all of those educational videos from previous market reports in the description box below. Talk about the ABCD patterns, talk about gaps, talk about roll reversal, talk about how to read the oscillators, talk about Fibonacci pullbacks. You name it, it's right in that description box. So go down there, click on some of those links, and you'll get an education just a few minutes at a time. Remember, these videos don't go very long. I like to think of them as daily vitamins, financial vitamins, that is, to help you learn how to read the charts. Now, one of the other reasons I think we could go a little bit higher on Monday and Tuesday on the diamonds is because we have a buy signal on the CCI and the stochastic is pivoting higher. Keep an eye out for the next turn lower because, as I mentioned, here is A, and we're waiting for the pivot before we could put B. So now we can put or label that pivot as a B. Any kind of a downturn would allow us to put a C, and that ultimately leads to a lower D. And that is exactly what I am expecting. I'll show you more evidence as we get towards the end of this video. Now, again, like I mentioned on Wednesday, we were looking for a bounce in all the markets. We did get that in IWM. In fact, the day right here, that red candle is when the midweek report went out, and we went right up to fill the gap. And now we have a little bit of a hanging man right there. I still think we're going to go a little bit higher, but then pivot lower, and that's why I'm keeping the ultimate downside target here at 198.95 for the small caps. Why? Here's why. We still have an open gap below the market that will most likely act as a price magnet. Once that gap fills, we might see a little bit of a bounce. So you swing traders out there looking to trade the up and down legs, that's very valuable information there for you. So again, I think we go a little bit higher, but then ultimately pivot lower to a lower D on IWM. Now, the big news in tech is that we got smacked today. You can see that we came right down to my target of 451.17. Look at that long shadow right there. You see, now that is a bullish candle. So to play this out, I'm just going to draw some more or less crayon marks here for you. I think we could get a little bit of a bounce off of that 20-period moving average and then start to pivot lower from C. Remember, A to B, we now have to wait for that pivot higher for us to label a B right there. But once we see a higher low, higher high, we can label that as B and then wait for a pivot lower from C before projecting down to a lower D. That's how ABCD patterns work. Get in the habit of recognizing those, and you'll see how good that is for increasing the probability on your trades. So again, a little bit of a bounce, then a pivot lower. I'm keeping that downside target of 425.73, again, because of that open gap right there. We filled this gap, hence the reason why I think we could see a little bit of a bounce. Remember, I teach through repetition. 80% of the time gaps fill. Then after they fill, 80% of the time prices reverse. So that is the cues. Looking at SPY, you can see same thing. We have a duplication of this down leg. SPY is lagging the Dow. I'll show you that in a moment when we look at some of the posts that came out on X this week. I believe that we're going to see this whole section here, that down leg, duplicate right here. So stand by, folks. For those of you that are loading up on long positions on SPY, be very, very cautious, because any kind of a pivot lower would lead us to believe that we're heading for a lower D. Now, this is not a pivot. Let me magnify that for you. A pivot is defined in the downward leg. A pivot is defined by a higher low, higher high. We only have half of a pivot. We have a lower low and a higher high. It's half of a pivot. Had the markets traded with a higher low, that would be a pivot, and we could put a B there. But we can't yet. If we see a higher low, higher high on Monday, then we could put the B, ultimately waiting for a downturn on C. I don't want that to sound confusing. Just go back and watch the videos over and over again. Even if you listen to them at 1.5 times speed, you could get through a video like this in less than 5 minutes if you put it 1.5 times speed, and you can still understand what I'm saying. If you have to review, just click on that rewind button. It's very easy for you to do that. So I think we're going to see a little bit of a bounce, then a downturn at C. Ultimately, I'm keeping that downside target of 501.22. Again, we have an open gap below the market, and that is most likely going to draw prices into that price magnet, as I call it. Now, looking at the VIX, remember, just about 2.5 weeks ago, I gave you a guarantee that gap right there would fill. Well, guess what? It filled. Now that it's filled, we pivoted away or lower from it, now filling the downside gap that was left on Wednesday. You see how powerful that information is? Knowing that gaps fill 100% of the time, and then we get reversals from those target gap fill levels. That's very valuable. Now, the VIX is still most likely going to head lower because, like I said, I think the S&P could rally just a little bit as it forms a C pivot. But if we go a little bit lower, I do expect the VIX to start to ramp up and start heading for my upside target right here of $18.38. So stay tuned for that. Again, if you want me to draw a little annotation here, I think with VIX would go a little bit lower, then start to pivot up, and then guess what we have on the VIX? We now have an A to B. Today we can put a pivot because we have a lower high, lower low on the VIX. There's a pivot to a C. When can we put the C? After we see a higher low, higher high on that down leg, ultimately leading us to a much higher D. So this helps you with timing your positions in and out of the market. Now I want to quickly visit Bitcoin. Here we go. I have a projection on this, a price target of $64,000. If you want to follow me on X, I do report on Bitcoin, especially after the targets have hit, and then I reestablish new targets for those traders who are getting in Bitcoin or even trading the cryptocurrency. Finally, let's take a look at SLV. You see this very hard pivot lower with that big red candle. Remember, I said we would go higher. We blew through these highs, but now we're heading right back down. My short-term target on SLV is 26.47, and I do believe we could head all the way down to the $23 level. Why do I say that? Well, I have to go to the weekly chart to show you why. That's going to be right at a key roll reversal. Remember, go to the description box and look that up. Resistance here was tested again here. Resistance was broken here. And this is all acting as a support level. Look at the super wide divergence from this moving average, right? That's what I call the rubber band effect. I do believe that silver is going to pull back to a level that we could see possibly a bounce at that moving average. But I have 25% of my SLV position sold. I have not yet bought into that. And again, this is something that I report on quite regularly, especially through X. Now, I want to draw your attention, speaking of X, to the great Martise. He has a pretty good sense of humor. And this one came out yesterday where he's showing the emergency meeting of all the bears in the stream right there. He said, pay attention. Well, that's true. We're having a lot of volatility in this market that's making investors very uncomfortable. How uncomfortable? Well, this is what I was talking about when I said that the Dow is leading the S&P. This is basically the same exact pattern on the Dow as it is in the S&P, but the Dow is leading the S&P to the downside. And so I'm not going to go out on a limb and say that the Dow is a leading indicator to the S&P, but it most certainly looks like a mirror image with the S&P most likely starting to head lower with what I would call a double top or an M top. You know, we're seeing a lot of unrealized losses stacking up in the banking sector. How big? $517 billion big, and that's just in Q1. Remember what I've said, as the banks are getting squeezed with this unrealized loss, it makes it much harder for them to loan money. That's where they make their bread and butter. If they can't loan money, then small businesses can't operate. And so that's only going to contribute to a slowing of the economy, and probably much more as the dominoes start to come down on the banking sector. I've been talking about this for many months. It's not getting any better for the banks. And so you have to understand the regulators are not marking this loss to the market. They are marking the losses to maturity, not marked to the market. There's a big difference. It's just a little bit of a loophole that they've given these banks to allow them a little bit more freedom to continue to operate. This is a serious flag that is not going away anytime soon. Take a look what happened to Salesforce in one day. They lost 60 billion in market cap. I think the general public is becoming numb to billions, right? Because they're now starting to throw trillions around. But this is a significant drop in Salesforce. And you have to understand that investors who got into this in one day lost the entire year's worth of gains. You see how that makes investors nervous. So when investors get nervous on even a stock like Intel, where they've given back all of the gains in 2024 in just 3 months, they start calling their money managers and say, listen, I'm uncomfortable. I'd like you to tell me how you're going to manage my risk. And what happens? The money managers get pressure because they want to make their clients happy. And then the money managers start selling out of positions to manage the risk on those portfolios. And it's not getting any better. If you look at American Airlines, crash and burn, down 40% from the 12-month highs. And here we go again. Dell, today, how are the long-term investors feeling about this? Again, this is the biggest drop that Dell has had since 2018. Today it dropped 20%. You think that's making people uncomfortable? It absolutely is. Now for traders, it's great. I mean, traders who are getting in and out on the up and down legs, especially option traders, are having a great time. They don't care if there was a retail smackdown like we see here in Kohl's. Their plans to boost sales have failed miserably. So while companies are beating the earnings estimates, and that's mainly because the analysts are putting lowball estimates out there, they're beating the estimates, but the outlooks are looking pretty grim. And that's why these stocks are selling off. When the companies come out and start to look forward and give the investors their outlook on some of these conference calls, the investors say, you know what, doesn't sound good enough to me to stay in, so I'm out. Remember, I follow the 7-point trading checklist. Anyone listening to my voice right now on YouTube could go to StickyTrades.com and set up a free membership. You don't need to put in your credit card or anything like that to get the 7-point trading checklist. Just go set up your member page, and then you could get my videos there. They're archived. The midweek report and the weekly market report are archived there, and you can pick them up on your own member page. Before I go, I want to thank each and every one of you for liking and sharing and especially commenting. I try my very best. Even on the weekend, I'm out there looking at the comments and trying to interact with our viewers. I try to get every question answered, or I'll at least respond to every one of your comments. You could just go check the comments page to see. I respond to every single one of them. So thank you. If you have any questions, just go right ahead, put them into the comment page underneath this video. Make sure you go to the description page and look at all the educational content that I put out on these very short videos. And then stick with us and please share, like, and continue to stick with Sticky Trades. Have a good weekend. I'll talk to you next week. So long.